Pause whatever you're doing, set your coffee down, shut the office door, and silence every last notification on your phone, because what I'm about to share with you doesn't just shift the playing field, it shatters it. If you don't grasp this in the next few minutes, you'll be stuck in the wreckage of the old financial order. Today is Monday, January 19th, 2026, and while you were sleeping, while you were glued to weekend charts, the US government quietly issued a death sentence for the COMEX. This is your guy, the Asian voice you know. You're probably staring at your monitor right now, watching silver sit around $93. You see Shanghai quoting it with a 1573 premium. You assume that's the big story. You think the $12 East-West spread is the real headline. It's not. That's just the echo. That's the noise a broken market makes. The real story, the one no financial outlet dares touch, is that a new beast has entered the arena. We've spent years tracking the giants, JP Morgan, CCP state buyers, Indian households. We thought we knew the titans. But as of this morning, all of them just got downgraded. A new alpha has surfaced, one that prints unlimited capital. I'm talking about Uncle Sam. We now have confirmed intel on a policy pivot so big, so aggressive, it should freeze every short seller on Wall Street. Hidden in the latest defense budget bill is a line that changes everything. The U.S. government has greenlit a $2.5 billion silver buy, aimed squarely at replenishing the nation's strategic stockpile, and silver sits at the top of that list. Let that figure settle in. $2.5 billion. Maybe you shrug. They print trillions. What's 2 billion? You're missing the physical scale. This market is small, tiny. At current prices, that kind of capital swallows a huge chunk of the entire investable silver pool held in registered COMEX vaults. But it's not just the dollars, it's the directive. Hedge funds buy silver carefully. If prices rise, they tap out. They have limits, risk controls. But this isn't a fund. This is the U.S. government buying silver for national defense, and they don't care what it costs. $90, $150, $500, it doesn't matter. They've been ordered to acquire metal because without it, missiles don't launch, satellites stay grounded, and the green transition their political futures rely on turns to dust. This is the pivot we've warned you about for years. We told you the day would come when silver would no longer be treated like a speculative bet, but like a critical survival resource. That day is here. Ask yourself, why now? Why is this happening on January 19th, 2026? Because the Pentagon sees what we see. They see the drain. They know America is addicted to imports. We bring in roughly 6,400 tons of silver annually just to maintain basic functionality. We depend on Mexico, on Peru, on supply routes that are cracking under real-time stress. With Venezuela erupting, with China trade routes unraveling, DC strategists know they're exposed. They understand that if the cargo ships stop, the war machine stops. So they're stepping in. But they're not stepping into a stable market. They're diving headfirst into a panic. Imagine a store with 10 loaves of bread. Outside, 100 hungry people wait. Suddenly, a billionaire storms in and says, "I'm buying it all, by order of the president." What happens next? Prices skyrocket. Supply vanishes. That's what this 2.5B operation is, a vacuum, and it's aimed straight at the vaults. It'll compete with Apple, with Samsung, with Tesla, and with you. This isn't just a whale. This is the whale, and this one writes the rules. Worst part? This sets off a chain reaction. The moment the big industrial buyers, solar firms, chip makers, defense contractors, realize Washington is panic buying silver, they'll follow suit. They must. If Apple believes the DoD is about to corner the silver supply, they'll rush in first. What we're looking at now is a bidding war between the strongest players on Earth, and the prize is a vanishing pile of metal. You have to grasp the mindset here. For decades, the U.S. dumped its silver. They sold off reserves, convinced that global markets would always provide. They thought they could just click buy when needed. That era ends today. This is the beginning of the just-in-case economy, an admission that free markets can't guarantee survival. So now, they intervene. When the government steps into a commodity market, they don't tiptoe in, they stomp through like a bulldozer. This $2.5 billion isn't the full move, it's just the opening blow, the down payment. Once they begin acquiring and realize how little metal is truly left, that number will balloon. They'll print as much as necessary to secure what they need. And that leads us to the most urgent question of all. Where are they planning to get it? If they turn to the COMEX, the registered vaults are going to hit zero in mere weeks. If they go direct to miners, future output will be locked up for years. There is no slack in this system. Mines are declining. Ore grades are weakening. Strikes in Mexico are choking off production. So what we're witnessing here is a silent, hostile takeover of the entire global silver supply chain. This is the spark that transforms a classic bull market into a full-blown market breakdown. Because you can't run a working futures market when the world's biggest buyer is hoovering up the real metal underneath. The shorts? They're done. The banks that went naked short, the ones that sold fake paper metal to millions, are reading this headline and vomiting into their bins. They know they're cornered. How do you close a short position when your counterparty is the federal government with an unlimited budget? You don't. You fail to deliver. So, while retail investors are watching silver sit at $93 and redrawing support lines, the entire foundation of the market has shifted under their feet. That number on the screen is a relic. It reflects a market that no longer exists. A market from yesterday when Washington sat on the sidelines. That's over now. Welcome to the era of strategic nationalization. And if you think this is bullish, you're underestimating what just happened. Bullish is when there's interest in buying. Strategic urgency is when buyers must act or collapse. This has moved from preference to survival, and there simply isn't enough metal to go around. But to fully grasp why the panic button was just smashed in DC, you need to review what dropped on Friday. You need to understand the data, the numbers that prove the vaults were being drained before the first check was even signed. This is the COMEX hemorrhage. This is the math that exposes the body. This is an autopsy in real time. Ask yourself something basic. If the US government suddenly decides it needs to rush out and buy $2.5 billion worth of silver, what did they see? Did they see a thriving market? Did they see excess metal just lying around? No. They saw what we saw Friday when CME posted its delivery data. They saw a massacre. They saw vaults looted, emptied, stripped bare. Let's unpack the COMEX death math, because these figures aren't just bullish. They're apocalyptic. To understand how broken this is, you need to know how the futures calendar is built. January is supposed to be a quiet month, what's called a non-delivery period. It bridges the large December and March contracts. Normally you'd get a few hundred contracts delivered, maybe a couple million ounces exchanged, just leftovers, a cleanup crew. But this year, the crew never showed. The looters came instead. Friday's official data shows January deliveries now total 41.44 million ounces. Let me burn that number into your mind. 41.44 million. That equals 8,288 contracts standing for physical delivery. In a month, that's supposed to be a ghost town. That's not routine. That's a bank run. That's a giant chunk of the available metal pool being ripped out in a matter of days. But that number is only half the story. If you want to see who's draining the lifeblood, who's pulling the trigger, you have to dig into the daily issues and stops report. That's the document that tells you which bank is offloading metal and which one is scooping it up. And what it revealed Friday was pure desperation. Just that day, 345 delivery notices were posted. That means 345 contracts stood up and said, "I've got silver to deliver." And who took nearly every single one of them? JP Morgan. Of the 345, their house accounts stopped 340. Do the math, that's 98.5%. JP Morgan wasn't a participant. They were the market. They stood like a goalkeeper, catching every single shot. So who was issuing? Who was bleeding? Bank of America. They issued 275 of those contracts. This is a knife fight between giants. Bank of America is hemorrhaging silver. They're the ones naked short. They're the ones scrambling to dig up enough metal to stay afloat. And JP Morgan? They're the predator, the bloodsucker. They're taking every bar off the floor because they already know what's coming. They know about the government's $2.5 billion bid. Hell, they might have helped draft the bill, so now they're front-running Uncle Sam, draining the COMEX before the Treasury even signs the check. Let's now talk about how long this system is left. Let's look at the number that really matters. Registered silver. That's the category of metal that is 100% ready for delivery, available, certified, and on standby to fulfill futures contracts. It's the only silver that counts on COMEX. As of the latest figures, that inventory stands around 120 million ounces. Sounds like a big number, right? 120 million. Now compare that to the burn rate you just saw. We just witnessed 41.4 million ounces vanish in a single month. A month that, on paper, was meant to be quiet. Now do the math. Take 120 million ounces of registered supply and divide it by that 41 million drawdown. What do you get? 2.9. That's 2.9 months. Under 90 days. That's not speculation. That's basic math. If this pace holds, and all signs say it'll speed up under the federal mandate, the COMEX vaults will hit empty by April. There will be 0 registered ounces left to deliver. So what happens when that moment arrives? When someone requests physical delivery and JP Morgan checks the vault and finds nothing but air, it triggers a buried clause most investors have never even read. Force majeure, acts of God, unforeseeable disruption. The exchange declares they can't fulfill your contract, and instead of handing you the metal you paid for, they cut you a check. They hand you fiat, maybe $93, maybe $95, and they tell you to take the cash and walk. But by then, the real-world price for physical silver, on the street, will be $200. You'll be forced out at a loss, watching the metal price rocket while holding paper. That's the trap. That's the hidden design. COMEX was never built to handle this scale of physical redemption. It functions fine when deliveries are light, when everyone just plays the paper game. But when 8,000 contracts demand real silver in January and the U.S. government enters as a physical buyer, the illusion collapses. Paper leverage destroys the system, and now we're watching the timer count down, moment by moment. January, 41 million ounces gone. February, another hit coming. March, that's the monster, the month where historically everyone demands delivery. If we have 120 million ounces now and lose 40 million more in February, we'll walk into March with only 80 million left. But open interest for March is pointing to demand of 300 million. You see where this leads? 80 million in hand, 300 million requested. That's a forced failure, a guaranteed default. And the insiders know it. That's why JP Morgan is scooping up every available ounce. That's why they stopped 340 contracts in one day. They want to be holding the metal when the lights go out. They want to be the vault, not the victim. They want to play the force majeure card, not be the ones it's played against. They're engineering the corner of the century and doing it in plain sight. But while Wall Street plays musical chairs, another market has already flipped the table. Another power has already declared the price is wrong. It's time to shift our focus east, to Shanghai. Because while COMEX fights to suppress silver to $93 to save the banks, China just lost the plot. They tried to cap the rally. They failed. Now let's zoom in on that $15 spread. Let's unpack why this arbitrage will gut what's left of the American system. This is where the fantasy price meets the real-world metal, and when they collide, the impact tears the global market apart. We ended the last section by telling you to watch the East. Now let's explain why COMEX is being emptied out. The metal isn't disappearing. It's being sucked into a gravitational black hole forming in Asia. Enter the Shanghai Gold Exchange. Right now, Chinese screens are flashing a silver price that's $15 above New York. For the past month, Chinese officials have been in panic mode, trying every lever to kill the rally. They see the same shortage we see, but instead of accepting it, they're attempting to regulate it into submission. Last week, the SGE dropped an emergency restriction. They slashed position limits from 7,000 lots down to 3,000. They told traders, stop buying, cool off. In a textbook market, that would have worked. Price would retreat. Speculators would scatter. But this isn't that kind of market. What happened next? Did silver pause? Fall? No, it exploded. It punched through the resistance and rocketed to 105.73. That's the ultimate sign of a broken engine. When the regulators slam the brakes and the car accelerates, the driver is no longer in control. That's what China is facing now. The demand isn't speculative, it's critical. Chinese industry, the solar giants who build 80% of the world's panels, must keep buying. They can't stop. If they do, their production halts, their contracts collapse. So when Beijing cut the limits, the buyers took it as confirmation. They saw the panic for what it was, proof of scarcity. So they pushed harder. They bought more. The rule change became a signal, and the signal was, buy it all now. And that's what sets the trap for New York. That's what fuels the arbitrage. Right now, as we speak, you can buy a silver futures contract on COMEX for $93 and immediately sell the physical bar in Shanghai for 105 plus. That's a risk-free spread of $12. That's a built-in 13% arbitrage just for shipping metal. What does that do to global supply chains? It flips them. It inverts the flow. Every bar refined in Switzerland, mined in Peru, or stored in London now faces a choice: sell for less in New York, or fly it to Shanghai and sell for more. There's no debate. The metal chases the highest bidder, and right now, the East is winning. That's why COMEX is collapsing. That's why JP Morgan is intercepting every single delivery. They're trying to build a wall, to hold back a tidal wave. But the wave is already breaching. That $12 spread is a gravitational force. As long as it exists, the vaults in New York will keep bleeding. COMEX is turning into a global discount bin, cheap silver for foreign buyers. The only fix? The New York price must rise. It has to shoot up to match Shanghai. It needs to surge by $12 overnight just to break even. And that's assuming Shanghai holds still, but it won't. But Shanghai isn't sitting still. It's sprinting past 110, now aiming for 120. The West is chasing a phantom, and while we're all transfixed by this heavyweight brawl, with Washington stepping into the ring and Beijing breaking the brakes, there's another casualty in this global price war. One nobody's talking about, one that's gasping for air beneath the boots of these giants. It's time we talk about the forgotten side of the battlefield, the retail buyer, the average person who's just trying to grab a few silver coins to protect their family. Because if you think this crisis is only affecting hedge funds and central banks, think again. The fire has now reached Main Street, and we've got proof, a smoking gun in the form of a letter. We need to talk about COMEX, the biggest online bullion dealer in the United States, and the silent disaster that just unfolded inside their private mint. If you were planning to buy silver next week, the store might already be closed. Let's go to ground level. Let's read the message. This is where the data on a screen turns into a real-world warning. Up to this point, we've covered the government, JP Morgan, Shanghai. But you're probably thinking, okay, but I can still buy a coin online, right? The option's still there, right? Wrong. Not only is the store closing, the entire mint behind it just broke down. We need to unpack the bombshell that dropped this weekend from COMEX, and more importantly, we need to talk about the letter signed by CEO Ken Lewis that's now circulating quietly in the inboxes of top-tier clients. This isn't a PR update. It's a red alert, a direct admission that the retail silver market just suffered a major failure. According to that internal memo, COMEX is now dealing with a demand surge 4 times higher than normal. It's their third busiest week in the history of the company. Under ordinary circumstances, that would be cause for celebration. But in the physical metals world, when demand outpaces supply, that's not a windfall, that's a crisis. And here's where it gets worse. Lewis admits to a significant development at their private mint. Corporate code for something broke. COMEX relies on its own branded bars and rounds for 90% of its sales. They don't just resell Eagles, they mint their own. That's how they keep premiums competitive and volumes flowing. But the letter reveals that due to a mechanical issue, or possibly a feedstock failure, they're not saying, production has collapsed by half. Yes, their output has been cut 50%, while demand is up 400%. Do the math. It's a recipe for full system paralysis, and COMEX knows it. They know they can't fill all the orders. So what did they do? Did they hike prices? No, they did something far more telling. They built a wall. As of this weekend, COMEX has enforced a $500 minimum on all silver orders. That's the velvet rope in front of the last lifeboat. If you're a small buyer, someone stacking $50 here, $70 there, you're done. You're locked out. The message is loud and clear. We can't handle you. You're too small to serve. They've prioritized the whales, bulk buyers only. 1-ounce customers are no longer welcome. And we told you this would happen. Back in stage 5, we warned that the market would fracture, that retail would be the first to get cut off, that dealers would start rationing metal. The $500 barrier is just the start. Next week, it could be $1,000, then $5,000. And then, the site will simply say, sold out. This isn't a one-off hiccup. It's a sign of systemic collapse in the just-in-time bullion pipeline. COMEX is the canary, the loudest one. If the biggest dealer in America, with the best supplier network and deepest capital base, is out of metal and shutting out small buyers, what do you think is happening at your neighborhood coin shop? They're empty, deserted. And here's the key. Tie it back to the big picture. Why is the mint broken? Why can't they get raw silver granules to make bars? Because JP Morgan is scooping up 340 contracts a day. Because Shanghai is pulling metal east with a $12 premium, because the US government is preparing a $2.5 billion grab. There's no silver left for the private mints. The upstream supply is gone. APMEX is essentially telling you the river has run dry. And this creates a feedback loop of panic. When people can't buy, they panic buy. The stackers who are waiting for a dip are realizing it doesn't matter if price drops. If the buy button is grayed out, price is meaningless. So they're pulling together $500, they're swiping credit cards, they're storming the gates, and that stampede will only accelerate the wipeout. This is what a true mint failure looks like. Not just a broken press, a broken system, a supply chain suffocating under the weight of a collapsing currency. The small buyer is being removed from the market, the door is shutting, and your fingers are still in the frame. But if you think this retail crunch is bad, wait until you see what happens next. Wait until you see how this retail freeze collides with the government's silver acquisition to unlock the ultimate legal escape hatch for Wall Street. We need to talk about April. We need to explain why the calendar is your enemy. We need to walk you through the coming force majeure, because we are now entering the most dangerous phase in modern financial history. The board is set. The players are in motion. On one end, retail, frozen out, dealers collapsing, mints failing. On the other, a trillion-dollar government program that's about to detonate the futures market. On the other side of this battlefield, we've got the whale wars, with JP Morgan and Bank of America locked in a knife fight over the last remaining silver in the vault. And looming above them like a Death Star is the US government, armed with a $2.5 billion war chest and a clear mission. Now it's time to lay these events on a timeline. Because this isn't an open-ended crisis. This isn't something that plays out slowly over years. This is a countdown, a fuse with a fixed burn rate, and it leads us to one date, April 2026. Why April? Because of the brutal simplicity of the COMEX delivery calendar. Let's walk through it. January, normally a dead zone, just saw 41 million ounces vanish. February is technically another low-volume month, but with this panic already boiling over, we can conservatively expect another 30 to 40 million ounces to be yanked out as industrial buyers race to beat the government to the punch. That would bring the registered stockpile down from 120 million to just 80 million ounces by March 1st. And then comes March. March is not quiet. March is the beast. It's a primary delivery month. It's where the largest futures contracts come due. If January, a calm month, drained 41 million, imagine what March will do. Open interest for March is already massive, and because the Shanghai spread is still $12 over COMEX, every major player has the same idea: stand for delivery. That means 80 million ounces, maybe 100 million, will be demanded, when only 80 million remain total. That's your wall, the hard limit. You can't ship what doesn't exist, and once the vault hits what's effectively zero, meaning the only metal left belongs to clients who won't sell at any price, the exchange is boxed in. Their only option? Trigger force majeure. Now most people hear that phrase and brush it off. It sounds like legal fluff, but it's not. Force majeure is the hidden trapdoor under your feet. It's the fine print clause that gives the exchange the legal right to refuse physical delivery if circumstances are out of their control, like a national stockpile seizure or a breakdown in supply. And instead of handing you silver, they hand you cash. Read that again. Cash settlement. That's the nightmare. Imagine this. You buy a silver futures contract at $93. You plan it well, you time the move, you hold through the noise, and then April arrives, you file for delivery. But COMEX says, we're empty. Instead, they cut you a check for $93 per ounce. Meanwhile, on the open market, physical silver is trading at $200, maybe $300. You're paid in fiat, but the real metal is gone. You did everything right, but your payoff vanished, because your contract was never backed by actual supply. You were holding a ticket to a rocket that never existed, and don't think the government will come to your defense. That $2.5 billion acquisition program is not a rescue mission. It's the trigger. They're not looking to help you, they're looking to take the metal. If COMEX invokes force majeure, it actually serves Washington. It purges the market of speculators. It clears the paper traffic jam. And it leaves the remaining physical bars wide open for the Defense Department to acquire under the Defense Production Act. This isn't a bailout. It's a power grab. That's why I call it a hostile takeover. The government and its preferred banks are moving in to shut down the casino and seize the chips. JP Morgan walks out with the silver. The government walks away with the metal. And the retail investor is left holding a check that can't keep up with inflation. That is the April event. It's the moment the link between paper silver and real silver snaps, for good. You're already seeing the early fractures, a $12 arbitrage gap in Shanghai, a $500 barrier just to buy from APMEX. But come April, that crack turns into a canyon. Price discovery dies. CNBC will still show silver at $100. Meanwhile, the street price, if you can even find it, will be unlisted. You don't want to be holding a future slip when that split hits. You don't want to be waving a piece of paper at a vault that's empty. The clock is set. Less than 90 days until the primary delivery window collapses the COMEX. JP Morgan is already clearing the runway, swallowing inventory in January before the storm hits. And the U.S. government, with its infinite checkbook, is lighting the fuse. This isn't a window closing. The window is already shut. There's only a crack of daylight left, which brings us to the final step. What do you do today? Monday, January 19th? How do you survive a financial steamroller already in motion? You don't trade. You don't wait. You secure the metal. So let's make this plain. Here are your final instructions for the week. Every hour from here is 1 hour closer to force majeure. Here's your summary. We've laid out the death spiral of the COMEX. We've shown you the production failure at APMEX. We've broken down the $12 price gap between Shanghai and New York. And most importantly, we've introduced the new apex buyer, the United States government, with a standing order to vacuum up the physical world. The story is not complex. It's brutally simple: a demand spike, a supply collapse, and a delivery system running on fumes. This is the endgame we've warned about for years, and it's converging on spring 2026. You need to understand there is no reversal. When Washington declares a resource vital to national survival, the price doesn't dip. When JP Morgan corners 98% of delivery volume, inventory doesn't magically restock. When America's top bullion mint cuts production in half, those coins don't reappear next week. The trend is locked. The outcome is clear. We are heading for a world where silver can't be bought, only hunted, only bartered, only known by name. The age of one-click silver is over. So what's your move? What do you do while the rest of the world hits snooze on a Monday morning? You don't stare at a chart waiting for a dip, hoping for $85 while Shanghai is screaming $105 is like waiting for a sale on fire extinguishers while your kitchen is already burning. The price you see is a distraction. It's bait. It's designed to freeze you in place while JP Morgan and the Pentagon strip the vault bare. Don't fall for it. If you find physical, get it. If a dealer has inventory, lock it in. Pay the premium. Pay the shipping. Pay whatever it takes. Because the premium you pay today is your lifeboat fee. Next month, that premium might be 50%. By April, when force majeure is triggered, the premium might be infinite. Because there will be no metal for sale at any price. This is not just the end of paper silver. It's the end of the illusion that fiat can conjure real value. The U.S. government knows it. That's why they're buying. The Chinese know it. That's why they're hoarding. The billionaires know it. That's why they're leaving. The only person who doesn't know it is the guy watching CNBC thinking silver is just another volatile metal. Don't be that guy. Don't be the one holding a paper promise when the system flips. Be the one holding the bar. Be the one holding the asset with no counterparty risk, no print function, no leash. This is your final warning for January. The 41 million ounce withdrawal, that was the gunshot. The APMEX letter, that was the scream. And the 2.5B federal buy order, that's the bomb. The explosion is happening. The vault is empty. The door is closed. If you're in, you're in. If you're out, God help you. This is John A.G. The whale has surfaced. The clock is out.